before when we were bringing you on, we were talking to you about some of that delayed data that's coming up later today, the October-November jobs report. The combination of that, we're looking at potentially, the estimate at least, 50,000 jobs added, unemployment ticking up to 4.5%, highest level since October of 2021. I want to ask you, does that matter to the markets? Does it matter to the Fed when we know there's going to be a lot of twists and turns before that next Fed meeting?
Well, there'll definitely be some twists and turns before January, but we think it does matter to investors right now. And more than anything else, if it's above and beyond what is anticipated. So if we come in at a 4.5% unemployment rate, if we add the jobs that are roughly expected, I think it's a non-issue. Now, if it does for some reason, and we have this gap because of what happened in October with the shutdown, if it were to spike more or we weren't able to add as many jobs, I think that's where the market gets a little spooked.
All right. So you're saying it's a non-issue. Is it a non-issue for the Fed, for the market, for both? Because I would think a relatively strong jobs report with an elevated unemployment picture, when we're talking about the unemployment rate, that's a little bit tough for the Fed. I mean, the Fed is, we heard Jay Powell say that they are looking at the labor market, even though they kind of think things are steady right now. That unemployment ticks up to 4.5. Isn't that starting to become concerning?
You're spot on. And if you look at the futures market right now, it's saying that it doesn't anticipate another cut in January. I think it's only about a 25% chance of a cut. If we were to see that unemployment rate be higher than anticipated, if the Fed is getting a little bit scared, I think that changes some minds. And then we get backed up with some of the inflation data later this week. So you really do have this push and pull going on right now for the Fed around what do we do? And I think it was great to hear from Chairman Powell last week about they don't argue about the current status on either inflation or unemployment, really. It's really more about the weightings between those two.
Okay. Obviously, we're seeing some weakness in the market, specifically when it comes to the AI trade. I'm looking right now. Wells Fargo out with a report today. They say dips become opportunities. They actually say the weak data, at least in the near term, is better for stocks, and they're looking ahead to next year. So are you a person that believes in buying the dip right now and that this weak data just creates an opportunity because there's going to be potentially more income for consumers coming up next year with tax breaks and also tax returns? And the report cites a number of other things. But is right now the time to buy this dip or to be worried about the volatility?
We think you should be a little bit worried about the volatility. We don't want to go running into it. And I think more than anything else, as you talk about this AI trade and the tech sector, the reality is we've had such an incredible tailwind. And yes, we've seen a little bit of pullback of late, but the reality is that people have gotten so excited about what's going to happen. We think they may want to give a little bit of pause here as we go into the beginning of the year. We do think there's going to be some tailwinds as we get into Q1, into Q2. But over the next month or two, we think it's going to be a little bit more volatile.
All right. You also came out with your 2026 outlook. The thing I want to talk to you about are bonds. You're saying fixed income is looking less attractive going into the new year. Is that simply because you're seeing a dovish Fed, or is there some other factor?
More than anything else is the starting point matters. And we think about where bonds are. It's hard for us to envision a scenario where, one, rates go dramatically lower without there being some type of recession, which is not our base case. And so we think it's going to be more of a coupon clipping type of environment. You can still pick up a little bit more yield on the corporate side or with high yield, but we just don't think you're going to get the nice tailwind with rates coming down through the beginning of next year and into the end of the back end.